Blackstone corners the real estate market. Blackstone has emerged as a real estate juggernaut over the past decade, amassing America's biggest private property empire. But one of the fastest-growing, most lucrative corners has become a quiet concern to some investors and analysts. Only launched in 2017, Blackstone Real Estate Income Trust, or BREIT, has grown rapidly. Its net asset value hit $70.04 at the end of September, according to a filing made earlier this week, thanks to a series of acquisitions, robust performance, and wild inflows from income-hungry investors. Add in a decent dollop of leverage, and its overall assets have soared to $126 billion, a separate fact sheet indicates. The success of BREIT is a matter of some pride inside 345 Park Avenue. Here's what Blackstone's chair and CEO Steve Schwarzman said at the end of Blackstone's second quarter earnings call with Wall Street analysts after detecting a whiff of concerns over the trust. Cornball anecdotes aside, BREIT has smashed it, returning on average 13.3% annually net of fees since its birth, including a 9.3% gain in Rate Rack 2022, and amassed a real estate portfolio that any Gulf royal family would envy. Its $126 billion of property-related assets range from a luxury rental apartment complex in Jacksonville, Florida, and the Jaguar Marriott in San Antonio, Texas, to data centers in Virginia, student housing in Georgia, industrial properties in Alaska, and self-storage depots across Texas. You can see each of its roughly 5,000 properties online, and below is the overall breakdown. NB, this is as of end June and doesn't include some holdings of property-related debt, which is why there's a discrepancy between the asset value below and the end September figure given earlier. Real estate investment trusts are a huge business in the U.S., allowing ordinary investors to buy a slice of a big diversified property portfolio. The National Association of Real Estate Investment Trusts estimates that U.S. REITs collectively own over $4.05 billion of property and have a stock market value of about $1.10. However, BREIT is unusual in being a private, unlisted REIT. Most of its peers, like Simon Property Group and Prologis, have shares that trade on a stock exchange. There was long a bad smell hanging over private REITs. Since they first emerged in the 1990s, the initial sales charge and ongoing management fees have generally been high. Shares are often offered at a fixed price, redemption rights are limited, performance has often been mediocre, and lifespans have proved finite. The law firm Goodwin Procter has a good history of the space. It was generally seen as a bit unsavory. A decade ago, the Financial Industry Regulatory Authority issued an investor alert warning investors about non-traded REITs, and subsequently fined several brokers for various misspelling infractions. This added to the sense that serious investment firms should stay away from the space. Morgan Stanley analyst Michael Cyprys told us, at least until Blackstone decided to jump in. BREIT is now a central plank in Blackstone's attempt to broaden out from selling its funds to big institutions like sovereign wealth funds and pension plans to ordinary-ish investors. In fact, it's arguably the central plank in that retail strategy. You can see its growing importance in these Goldman Sachs charts, which show BREIT's explosive growth since 2018 and the investment bank's forecast for chunky inflows in the coming years as well. Goldman's report came out this summer, so its numbers go up to the end of the first quarter, plus its forecasts for the next 2 years. But we checked the third quarter results that came out yesterday, and BREIT now represents about 10% of Blackstone's entire pool of fee-earning assets under management. Even BREIT's size actually underplays its rising financial importance to Blackstone. The trust charges a 1.25% annual management fee, based on its NAV, and a 12.5% performance fee on its annual total return, subject to a 5% annual hurdle and a high watermark. Given its swelling heft and returns, the trust has become a gold mine for Blackstone. Last year, BREIT threw off $1.44 billion in fees and alone accounted for about a fifth of Blackstone's overall fee revenues. According to Goldman Sachs, Blackstone doesn't seem to break out its fee revenues from BREIT. Goldman forecasts that this could rise to $2.03 billion and 23% of Blackstone's fee revenue by the end of 2023. By almost any measure, BREIT is an incredible success story for Blackstone, one that rival executives talk enviously about. It's no surprise that photos of the company's president, Jonathan Gray, are plastered over BREIT's website and investor documents. After all, it's the kind of big win that makes Wall Street careers, perhaps even solidifying a candidate, as Schwartzman's heir apparent. Here's Gray talking about his beloved BREIT earlier this year. However, FT Alphaville cannot help but wonder if BREIT might be facing a far less hospitable environment over the next few years. In fact, it looks downright nasty. And the trust is now so big that any setback would be meaningful for Blackstone more broadly. Firstly, this kind of yield-generous product, BREIT's annualized distribution rate has been 4.4% since its birth in 2017, was like manna for investors in the low-interest rate era. When BREIT launched, the average global bond yield was just 1.7%, making it obviously attractive as an alternative to investors who craved a steady income stream. But a one-year Treasury bond now yields 4.6%, which is more than BREIT currently throws off. Investment-grade U.S. corporate debt yields 5.9%, and junk bonds yields are approaching 10%. The inflation-triggered rise in fixed income yields is a seismic change to the attractions of REITs and a host of other bond proxies that have done well in recent years. At the same time, rising interest rates are a huge threat to the U.S. real estate market, especially housing. Americans are blessed with the marvel that is the 30-year fixed mortgage, so rising rates take a while to bleed into property prices. But look at how the average cost of a 30-year mortgage has rocketed this year. From about 3% at the start of the year to nearly 7%. That's going to hurt a lot of the frothier regional real estate markets that took off after the pandemic, and housing makes up 52% of BREIT's portfolio. Rising rates are also going to hurt commercial real estate, large swaths of which have already been battered by the work-from-home trend, and also make up a decent chunk of BREIT's holdings. The combination of more yield-generous investment alternatives and the possibility of a potentially wide-ranging property downturn is obviously not great news for real estate investment trusts like BREIT. Are there any public market proxies for what the market thinks the outlook might be? Conveniently, there are. Goldman Sachs reckons that BREIT's geographic tilt towards residential property in the American Sun Belt means that Camden Property Trust and Mid-America apartment communities are the best public equivalents. Look at what their share prices have done over the past year compared with BREIT's net asset value. Obviously, NAV's stock price is not a great comparison, dual axes, and BREIT has hardly been immune from the budding real estate downturn. As a footnote in a recent performance update obliquely says, is this just the beginning? As rising rates deflate the U.S. real estate market, reverse the employment boom, and dampen appetite for yieldy investment products like BREIT? Having talked to a few prospective investors in recent months, it's clear that some are wary of BREIT for exactly these reasons. Even Goldman's note this summer mentioned that the investment bank had. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.